Hi everybody, it's Darren. Just wanted to come to you with a quick video now that we're into the new financial year. It's a happy new financial year, and I realise for most people out there it's really quite an unimportant milestone in the year, but for those of us in financial circles it's quite an important time of year, and a lot of the rush period before 30 June ends this week, so that's a bit of a relief for me and some of the staff when some of the rush is over. I just want to talk about a little bit that's in the media. There's obviously the Greek debt is at the forefront of that at the moment, with effectively them defaulting on the debt and really unable to service the debt they have. That puts them in obviously a pretty precarious position. Whether they exit the euro or not is really quite uncertain, and it's not a particularly good outcome if it does for them, because their economy could go through quite a hard time, and it will devalue their economy quite heavily. So I would have thought they'd do everything they can to avoid that, but we'll see, because they're being pretty bravado about it at the moment. That's not helping their relationships with the people they're dealing with. In terms of its effect on Australia, Greece is the 112th largest trading partner with the US, with Greece, which really puts them at 0.1% of our trading globally. So it's tiny impact to our foreign trading with them. So there's really not an impact economically for the country. As far as the share market goes, it's not really a direct impact, because none of the companies that we own with our clients actually have any exposure to the region at all. The impact is the confidence piece. So when the last couple of months market's been a little bit off because of the concerns around Greece debt and a few other things in the background, and obviously this week and the last week since it came to the real surface, we had a little bit of negativity in markets start of the week, but that's actually recovered pretty quickly. So it's really the down day of Monday was eroded pretty quickly, which makes me laugh, because the media that night was going on about how many billions was wiped off the share market today, and they act like it was money that was flushed down the toilet, when in reality share markets are up and down every day, and it really is of no consequence how much the quantum of the move is on one day, because it can be eroded in a couple of days, which is exactly what's happened. The market's been up since then. So what it means, I guess, for companies itself is pretty important. The earnings of the companies that you have aren't affected by this, and we've also been in touch with all the fund managers that we deal with, all the managed funds that you own, and made sure that none of them have any exposure, and we've confirmed that. So really the impact is mainly just an emotional overlay, and for those people that have got plenty of cash and fixed interest and their spending is safe, which is the concepts I like to keep in the focus, so that people are, their incomes and their bills can be paid and all these kind of things. That's the important thing. So for retirees, lots of cash and fixed interest, and if you're working age, having enough cash for upcoming major expenses and already put that money aside, that's good risk management. Because the biggest problem with share market falls isn't really the on paper value that things have fallen by, because they can be eroded pretty quickly in recovering markets, but the impact is if you have to sell anything during times like that, and that's where it really becomes a problem, because if you're having to sell when markets are poor, then you're taking losses that you don't want to have to take. So again, the only way to really manage that is to make sure you've got plenty of cash and fixed interest on the side ready for those occasions. So always having a bit of a cash reserve if you're working age, and if you're retired, again, big fat cash and fixed interest deposits. Now, I guess earlier in the year, in the first quarter, I was taking some profit from a few things in portfolios that were overweight, and bits and pieces, just letting cash build up a little bit more than I normally do. And people occasionally asked, is that some money we should be investing, or what should we be doing with that money? And my answer really was that I was happy to let it build up, because we did have some uncertainties coming. We had the Greece debt, we had US interest rates, which still are on the cards to go up some stage, and that'll cause a ripple through markets too. So having extra cash and fixed interest is a good thing, because when markets fall, we can go and use that money to good work and buy some things cheap. So I thought that was worth reiterating, that sometimes when you see me build up cash, it's not because I'm being lazy about investing it, it's just because there's a good reason to have cash at the time. As the more expensive markets are, the more cash and fixed interest we should have in portfolios, and the opposite is true also. If markets crash the last thing you want to think about during a crash is investing, but that's exactly what I'll be asking you to do. So if markets fall heavily, I'll be saying, how can we buy things while they're cheap? I'm not particularly emotional about that stuff, so which is important, I think. So that's gives you a bit of insight, I guess, what's going on. Also a bit of insight to how this plays out in terms of looking at your portfolio specifically. So yeah, not much to worry about, and everything's as far as the companies we're investing is largely intact. The only thing on the radar really at the moment is Woolworths, because despite it always being this resilient investment that's particularly robust and immune to economic forces, for the first time we're seeing a lot of competition come in from Aldi and Costco, and that's putting pretty big pressure on the share price. We haven't seen too much softening of the earnings yet, so the share price still does look pretty cheap for the earnings at the moment, and it really comes down to how far the earnings come off in that competitive environment. The share market is basically pricing in a 15-20% fall in earnings, which is actually a bit far-fetched, I think, at this point, where there's a lot of commentary in financial circles around the share price is way overdone and it's just too cheap to be selling, and that Woolworths should be able to right the ship a little bit. I think we're going to see a lack of earnings growth for a while, and earnings might be a little soft, but I doubt we'll see 20-25% come off the earnings anytime soon, because it still is a pretty robust business in a lot of ways. It's just experiencing competition that many other industries have always had. It's just that Woolworths and Coles really have never had quite a aggressive battle between them. They've always had a friendly fight and probably just agreed to make lots of money. So it's a pretty long video. We're up to 7 minutes, so I don't like to talk too long, because I know that people have better things to do than hear me drain on for hours. So otherwise, if you've got any questions, just reply to the email, and I look forward to talking to you all very soon. Bye.